I don't know how many of you guys have been reading the headlines on what's been happening with McDonald's business, and McDonald's stock, but there's a lot of negative news with regards to the company. So if we take a look at McDonald's lays off hundreds, cuts pay for workers, closes field offices. McDonald's is laying off hundreds of employees in its corporate offices, cutting pay and benefits for others, and closing field offices as part of a company-wide restructuring, according to a report. According to internal emails obtained by Wall Street Journal, the Chicago-based fast food giant informed restaurant owners that it would shutter field offices in the coming months. Shutter, that's just a spelling mistake, that it would shut field offices. While the McDonald's brand is in the strongest position it has been in years, we also recognize that our business has grown increasingly complex in recent years. Joel Erlinger, president of McDonald's USA, said in the email obtained by the Journal. Several of those who were laid off were executives who spent decades with the company. Tim Anderson, who served as vice president of operations and development, posted a note on LinkedIn that read, "I was informed last week I was starting my planned retirement 3 years early due to a large reorganization at McDonald's. Although I always wanted the decision to leave to be mine, I am proud of the 42 years I spent with the brand, with incredible people, blah, blah, blah." Anyway, let's read in between the lines. McDonald's, they're letting go of a lot of people. They're trying to cut expenses with regards to their employees. They probably see the tough economic environment that we're in and the potential tough economic environment that's ahead. And they're saying, well, let's cut costs and let's try generate more cash flow. Let's generate more profit. So you read these headlines. What do you think is going to happen to the stock? Just have a guess. Most likely you would assume, okay, the business is struggling. The stock's going to go down. No. That's actually not the case. McDonald's stock over the past year, okay, it's up. It's up by 20%. Over the past 5 years, well, let's say since 2020, since the pandemic, it's up 100%. Since 2012, it is up 200%. The stock, and just in terms of price, has done really well lately, despite negative headlines in the news. Now, why is this the case? Because if you actually look at their fundamentals are not that great either. So let's look at revenue and income. Revenue has basically been hovering around the same amount for a long period. Let's just say over the past 5 years, it's still sitting around $22, $21, $23 billion. So they're really struggling to grow revenue. It seems like they've plateaued in terms of their business model. And income, yeah, it's kind of a similar story. $5 billion, $6 billion, $7 billion, $6 billion, it's hovering around $6 to $5 billion in terms of income. And even if you look from a longer term perspective, revenue in 2013 was $28 billion. And now revenue is $23 billion. From a longer term perspective, revenue is actually down. Income's around the same amount, that $5-6 billion mark. Yet the stock is absolutely on fire. Over the past 10 years, it's up 200%, as we said. And even recently, it's up 20%. So why is this the case? Well, one, this speaks to the fact that the market has just gotten so much more pricier over the past 10 years. A stock that fundamentally is doing exactly what it was doing 10 years ago with little to no growth is priced 200% higher than what it was priced at recently. It just shows you how pricey the stock market is, how many more investors are playing the game, how much more money investors have. Why do I think the stock is up recently? I just think that hedge funds are looking for safety. The news headlines are saying a recession is coming. People are saying, well, the economic environment is more shaky than what it was before. And hedge funds, what do they look for in these types of times? They look for safety. They look for stocks that have been around for long periods of time, where the business model is considered stable, and everyone knows that, well, even if the economy is down, people are still going to buy McDonald's. They're still going to need food. And hedge funds like to show their clients that they own these safe type of stocks. This is why I think, over the past year, the stock is up, despite fundamentals not really doing anything. This is my reason why. Now let's take a think of McDonald's stock, and would we want to buy the stock? Now I'm not going to say, I shouldn't say would we want to buy the stock, because that's your opinion if you want to buy the stock. this is my opinion on the stock. Let's try calculate the intrinsic value, what I believe the intrinsic value could potentially be on McDonald's stock. Now with these numbers, I've been pretty generous. So I'm going to do a starting year one cash flow of 6.88. The reason why is because, well, that's what their net income has been in the trailing 12 months. Okay, now let's go to the intrinsic value. So starting cash flow is $6.88 billion. Now, I always want to get a 10% return on the stock that I do, so 10%. Years to forecast, let's do a 10-year forecast. So the terminal PE, right now the PE for McDonald's stock is, where is it? Let's move my face out the way. It's 32. So let's say in 10 years time, let's be generous and say it's still sitting at 25. I think that's pretty generous. And the last ingredient that we need to determine is the future growth rate over the next 10 years in terms of our cash flow. So as you can see, in terms of revenue, they've really struggled to grow their revenue as we saw earlier on. And as we can see here, they've grown revenue at 1% over the past 3 years, negative over the past 5 years, and over the past 10 years, it's been 1%. So their top line, they're really struggling to grow. Their net income, they are also struggling to grow, not as much as their revenue though. As you can see, net income, 4%, 6%, 5 years, 5%, 8 years, 4%, 10 years. So let's be very, very, very generous, and let's say they can grow their net income at 8% over the next 10 years. I think that's generous. I would rather use 4%. I looked at what the analysts expect, and they've got very high expectations, 29% year over year, 10%, 8%, 11%, 6%. So let's be generous. I think I'm being very generous, and let's say earnings grow by 8% over the next 8 years. So let's calculate that and see what our future cash flows will be, and let's see what our intrinsic value will be as well. As you can see, let's zoom out. These are our future cash flows based on an 8% growth rate. And this gives us an intrinsic value of $190 billion. Even though we're being generous, it's still below the current market cap of McDonald's. Still below the per share price. Our intrinsic value is below the price McDonald's stock. And yeah, so despite being generous, it's still below the price. And this is why I'm not going to own McDonald's stock. I don't want to pay 32 times the current income, 32 times in terms of price, the current income of the business, a 32 PE ratio for a company that's barely grown, that's already grown throughout the whole, that all their growth happened in the past. How much more growth does McDonald's have? Well, I don't think there's much more growth in this business. Why would I pay 32 times earnings on a company that is struggling to grow? That is why you're not going to see me owning McDonald's stock. I think they're more in their mature phase of growth. They're just going to pizza, deliver good income, not really grow their income by that much in the future. It's too pricey for me. I'm not going to own McDonald's stock. I've done my intrinsic value calculation. Okay, let's move on to the next stock because I don't want to own McDonald's at that price tag. By the way, all of this was calculated on BuffettInvestors.com. And I'm going to copy my link to my calculation. I'll put it in the description below so you can see the way that I've calculated intrinsic value. You can mess around with these numbers here and, well, do your own numbers, because at the end of the day, investing is an individual game. You have to make your own decision on each stock that you buy. These are my numbers. Play around with your numbers. Tell me what you get. And yeah, so I'll leave that in the description below.